Hello, everyone. Welcome back to the Trading Room. I'm Shane Vernier, and this is the Thursday U.S. Mid-Session Brief. Today, we're going to talk about the elevated risk appetite, or lack thereof, in our markets. We're seeing just blood red all over the tote board right now. You're seeing U.S. stocks really crash. Oil's up. Stocks are down. This is the correlation. If you're not familiar with that negative correlation, get familiar with it. This is one of those things that has been persistent. It's happened over and over and over again over the past, 3 weeks, 3.5 weeks, 4 weeks. And we've got a real situation developing here where the rubber is hitting the road in the U.S.-Iran-Israel war, and this is an inflection point. There's no question about it. As we roll into this weekend's trade, we've got to be diligent. We've got to understand what is happening on that front. And I've got some stories here that are interesting. We've got some economic news that dropped earlier today that really isn't much. I've got my eyes more on the bond market than I do on the U.S. labor market, but we're seeing that exodus, that mass exodus into safe havens. But the safe havens, metals, nope. That's not where the money's going. The money's going into bonds, and it's obvious now what's happening. So I want to welcome everybody back to the stream. If you have any questions at all, be sure to ask. If you want to say hi, that's great as well. Feel free to weigh in with anything you'd like. That's what these things are all about. It's all about being an interactive experience. So good to see everybody back in the room. Tuku over there in the How to Trade community. Good to see you, Tuku, and everybody out there in YouTube land. Welcome. All right, guys, let's go ahead and get to the heightened risk appetite that we're dealing with here today. I keep saying risk appetite because that's sort of what the VIX is. When the VIX goes up, it means that, yeah, the market really is scared and things are getting riskier and riskier, especially for traditional risk asset bulls. Now, as far as a risk appetite goes, typically a risk appetite is when we want to take on more risk and we want to get involved and really buy these risky assets in the hopes that they're going to go up. That's not what we're seeing right now. So the risk appetite is dead. I mean, it is dead. These markets are very heavy. It seems like no matter what happens, we go up, we come down. And that essentially is the name of the game right now. We had a big bullish run early in the week from U.S. stocks, and now we're just selling off consistently almost every day. These aren't huge, dramatic plunging losses, but they do show that the market is very heavy. We're not looking at earnings reports. We're not looking at really anything else but the Iran war. That's the number one market driver in the world, no question. Let me see Jason. Good to see you, Jason. Welcome. Ralph H., good to see you, Ralph. So this is a good look at our CBOE volatility index. You will see right here our long-term average is 21. Today, we are up. We're up about 8.25%, and we're starting to trend towards that elevated level of 30. So I always mark 30 as being sort of I would say not necessarily that we're in panic mode, but when we're around 30 in the VIX, it means that there is trouble in paradise. People are definitely watching the downsides of these markets, and the potential risk appetite is falling. So even though volatility is picking up in the S&P 500, no question about it, you're starting to see us get into the upper echelon of this VIX, this VIX range. So right here, you got the high right there, 28.99. I was back in October. That was when that carry trade was in question again, 28.27. And then you can see the big spike that we had, I believe, right during this war here, and this was last Monday when we had the big, really the big announcement from Trump, the ultimatum, and then backing off of the ultimatum. And now, I mean, we're trending higher. There's no two ways about it. It feels to me like the VIX is loading up and getting ready to make another leg higher, just waiting on that escalation news. We're going to cover that again today. U.S. 10-year note, I talked about this in the pre-market, this week's Switch On Hot Picks, and we talked a lot about the 10-year note and what this means to the broader sentiment in the market. And you can see that yields are definitely up this year. They're up about 6%. I've got these pointed out, 5.289%. That's the 2007 financial crisis. That was a big time, key time. Bear Stearns collapsed in the fall of 2007. And that was the beginning of really the rush to 0% to try to stave off a depression. One of the worst recessions of my lifetime, 2008 through 2012, was not nice to many of us that were faced with weathering that storm. A lot of reasons for it. But what I want to point out here in the 10-year note is that today we are up. We're up significantly too. Our yields are up about 1.80%. So remember, when those yields go up for, say, a 10-year note, that means that the U.S. government's trying to attract money. It means that they're trying to take capital out of the system. Long-term lenders are sort of expecting higher interest rates for longer. Couple that with the U.S. government's desire to raise money, you can see that these yields are going up. These yields are going up, and that is one of the reasons why some of our favorite markets, like a gold, is just absolutely plunging. Again, today you're off about 2.5%. We had a nice bullish bump. We thought maybe we were on the road back to 5,000, and today that's not the case. So there's a lot of market drivers at play right now. They all have to do with the Iran war, in my view. We're going to talk a little bit about employment, but I'm not going to waste much time, especially when it comes to trying to figure out what's moving the markets. We know what's moving the markets. Right now, I believe, or if it just finished up, Trump was having a cabinet meeting. There were some announcements made. I'm going to tell you those in a second. And they did absolutely nothing to reinforce confidence, either in your energy markets or in your stock markets. We're in for it. Buckle up. We're going into the weekend. Something big's going to happen this weekend. We're pretty much every weekend we've seen market movers. We think that we're in for another big one this weekend. Tina Jean, good to see you. Tina, welcome. Let me see your Andrea Garwell. Good to see you. If there's any other markets that you guys want to cover, be sure to ask me. I've got a little bit of an oil talk lined up for right now, and I think it's a good time to do it because what we're starting to see is something that we called a couple days ago, and it's panning out. It really is panning out. So if you want to trade U.S. oil or U.K. oil, WTI or Brent, head on over to Switch Markets. Trade oil with a 0% commission and tight spreads. What is oil trading? Well, if you need to know what oil trading is, you probably haven't seen any of these streams. I cover it pretty much every day. And during this war, it's probably the single largest commodity in the world, and it's the number one market driver. No question about it. How oil goes, the rest of the world goes. And as we see the prices in oil really rise, we're starting to see downward pressure on our risk assets. It's a negative correlation. So if you're interested, head on over to Switch and trade some oil and see if you can do it. A lot of folks don't believe they can. A lot of folks can. You don't know until you try. That's for sure. All right, so this is CNBC. This was a good one. Trump says Iran let 10 oil ships through the Strait of Hormuz as a present to the United States. Well, he said this at the cabinet meeting earlier today. The biggest thing that I want to point out here is that the markets just aren't buying it. They're not buying it. This is a good look at our market profile, our TPO charts on a 30-minute schedule for the entire week. So this is, a lot of traders really believe in TPO and volume profile. This is sort of what I cut my teeth on and what I'm schooled on is understanding what value areas are and when we're going to move and what we're going to fill in. I outlined this relatively early. It was towards the end of the Monday session. I said, okay, we had a B formation setting up. We had a little bit of a value area that formed up here, and that was during that London Open, shortly after the Electronic Open. A lot of business was being done at $100 crude oil to open this week, and then we sold off. Trump made the announcement. He made the big tweet, which was that, hey, there's a deal in the works, and we're going to give them 5 more days, and we're backing off of our 48-hour ultimatum to shut down their power grid. And then what happened during the U.S. session is you sort of had another value area develop. So what that did was that left a hole. That left a void in between these two value areas. And then one value area is at 100. The other value area is right down here around 90. This isn't rocket science, at least, not with commodities. Some of the other things are a little bit harder than this, but this is pretty easy. So you say, okay, there's a value at 100 and a value at 90. Where do we trade a majority of the week? Just sort of milling around. Low 90s, 91, 92, back down to 87, 87.50, back up to 90. Well, today you're finally starting to see that gap area get filled in. Now, it's not an according to Hoyle perfect gap. There was volume there, but that crash occurred over about 3 minutes. And what happened was it was all selling. There wasn't many buyers in there, and the buyers that were there, they got turned under, and they got turned under fast and lost everything, blew their accounts out. The biggest thing that we have to remember is that when we see a very, very thin chain, as you can see by this market profile, these are essentially volume on its side, basically volume according to the price points that are being that are being traded. What do you got right there? Well, you've got a very, very thin chain. You've got a very, very thin chain, not much volume there at all. And it only stands to reason that you're going to get sort of a fill-in of that zone. So we drew a little rectangle there, and you can see this today. We're just sort of clawing. It looks to me like we're probably going to test that 96 and a half, 96.74 at some point. But right now we filled it in. We have basically filled in that gap. So these things happen. They happen regularly. There was a lot of traders that were just buying consistently, figuring that they're going to get this late week rally, and it paid off really great for them. Can you, as a retail trader, can you build strategies like that? You can, but you've got to be really smart about what you're doing. That's where the point of controls and the value area comes in. I mean, we get out in the tall grass. I could talk about market profile and volumes all day. It doesn't really do us much good, but it does illustrate what's happening in the oil market. Number one, Trump says Iran let 10 oil ships through the Strait of Hormuz as a present to the U.S. That should have been a really bearish thing for crude oil. It should have said, okay, well, we're getting somewhere. The Iranians want a deal. We're going to go ahead. Okay, even 10 more cargoes of oil, that's good for the global market. Well, none of it worked. And now you're starting to see that the markets just aren't buying anything. They're not believing the talking points that are coming out of the White House. And that gives us the underlying sort of sentiment and idea that there's a heck of a lot of angst in here. And we're waiting basically for the first piece of news on escalation. That's the way these markets are leaning. They're positioned just perfect to where if you do get that escalation tweet or if you get that escalation move in the news, then you're going to see the oil price explode. It's going to go up to 110, 115, 120. That will happen relatively fast. Now, I don't believe it's going to stay there very long. I really don't. But it really depends on where this war goes from here. You can see it in the way that the prices are behaving, that we are at really an inflection point. At the beginning, Trump said 4 to 5 weeks. That was that initial statement I covered in the middle of the night live for you. 4 to 5 weeks. We're winding up week 4. Week 5 is right around the corner, and that's a timing issue for a lot of countries. Take a look at this. This was from 2 weeks ago. The biggest release of emergency oil stockpiles in history was announced. Why crude may keep rising. This guy wrote this 2 weeks ago. Oil prices surged 17% since the IEA announced its largest release of crude oils in its 50-year history. That was 2 weeks ago. The United States followed suit. They put a tremendous amount of oil on the market from their oil reserves. So what does all that mean? It means that you've done what you can do to keep the oil price down. Trump's dropping, he's making comments. He's trying to figure out ways to reassure these markets, and it's starting to not work at all. It worked on Monday with the big oil crash, and then the markets went way up. And now, as this week's gone on and there's been no resolution, essentially, you're seeing bullish crude oil is sort of the default position. We're back up to 95. Will not shock me if we don't get another big announcement or something by the end of the week. You could easily close up over 100. It could happen. Now, if you get a big announcement or something that actually has some gravity to it, maybe you get the huge sell-off. But for right now, everybody is hanging on pretty much any sort of developments from the Middle East, because most of us believe that an escalation is on the way. I'll get into that a little bit later. We'll check our poly market odds on the Iranian situation. But what we definitely want to stress right now is that the dynamic is this. The VIX is up. Those 10-year yields were up. That's taking money out of gold and silver. Gold and silver are in big trouble right now. You're taking all that money out of those safe havens. You're putting it into a 10-year note. Is that good or bad? It really stresses that the unknown is starting to bother even safe haven traders. Going into the weekend, we've seen big news the last several weekends. What happens from here? Nobody knows. Well, I'm going to make a video on, some people know. Clearly, there's insider trading going on, but I don't know if they're in the administration or if they're technology people or if they just they have an inside track on data flows. I mean, honestly, we don't know who's doing the insider trading. I don't. Most people believe it's people inside of the administration. That would make sense because they're privy to this information. But you could have somebody sitting outside of the White House picking off these supposedly encrypted messages and saying, okay, Trump just wrote his tweet, and let's go ahead and short crude oil. I mean, it really could be happening. We don't know. And I'm not going to sit here and pretend to know. All I know is this. These markets are very, very fickle right now, and they feel like they're standing on a razor's edge. So I'm very careful. As far as gold goes, I always get the question every day, so I'll cover it right now. I'm in an absolute holding pattern for gold. I've got nothing for it. I'm watching closely. Here's our 38% level that should have stood up and didn't really for us earlier in the week. But now you're starting to see the compression around that 44.25 level, 44.25-ish. Now you're starting to see what real compression is. There was your inside bar. There was your break to the top. Top side was about 4,600. I said, okay, maybe we'll get back to 5,000. It really looked that way. I was waiting for the big move, and now you're starting to come down and settle in right there at our 4,000, maybe 4,025. There just isn't anything there for me. I'm not interested in even trading it. If I had to scalp it on an ultra short time frame, I would go to my 30-minute chart today, and I'd say, okay, what's happening? All right, 30-minute chart. We've got sort of a spike high right there. That's sort of the New York high at about 10:30 a.m. Eastern. You get that spike high right to there's that spike low, and then maybe you could sell up in here. I hate it. I don't want to be any part of it. I think that it's really just it's ugly. It's discombobulated. It just is not there, in my opinion. I would be on the sidelines with gold right now, but if you guys are taking sides and you're picking directions, best of luck to you. Watch your risk. This kind of thing right here, I mean, this is another great test of that 38%, and then you bounced, and then we sort of gave way during the U.S. session, and now we're just milling around. I mean, even though you're off 2.5%, I'm not really interested in playing a trend day. I don't know that we're going that much further south. No, I'm not. I don't want it. I'm sorry. I've lost my spirit for gold, at least until maybe next week sets up. But if I had to make a trade, Shane, gun to my head, what do I do? I would say I'd wait and probably sell right up there, right beneath that key level. Probably be selling this area, maybe 427, 44.2750. You might be able to get that and maybe get a $5 move. But with 115 pip spreads, you're going to need more than $5. Probably need $6 or $7 to make that worth your while. That's a hard one. If you guys are trading gold successfully this week, then you're killing it. We've done very well in gold this year, no questions about it. We had a loser Monday that was rare. That was my fault. I take responsibility for that. Should have just taken the $15 and just walked, but I thought we would get the big move off of that level, and we still may. But right now the timing is just messed up. It's just messed up. So I'm definitely not interested in gold so much right this minute. Let me see. Naomi, good to see you. Somebody definitely knows and usually does. They always know. We're on the outside. We're outside the party. We didn't get invited to the party. That's okay, though. There's no point of being angry about it. We can't do anything about it. All we can do is really, if we're going to play the game, be smart about what we do. And if we can only control what we do, we can't control what's happening behind the scenes. The best thing I can always say is just stay awake. Don't go to sleep with these positions. Don't be one of those people that just hopes things work out for you. That does not work. It just doesn't work. So it's hard to account for, and it can be really expensive. But stop loss is down, leverage in check. 1 and 2. You got to do it right now just because it's so crazy. Let me see. Marvel, good to see you. Marvel, welcome. We got an interesting trade idea to recap. We have a couple of pairs that I'm going to look at here. We have one that went pretty well. This dollar CAD trade is starting to frustrate me a little bit, but we're going to cover a couple of trade ideas that we put out very recently. So here we go. This was the first one that came out earlier this week, Great Britain Pound USD. This was an interesting trade. I found it to be pretty entertaining. We went up and got our points, but not by a whole heck of a lot. Still, though, we identified a really nice support level that was right around that 133.38 area. Pretty good stuff. And you can see right there's our monthly chart. And we've got sort of our support zone. We're trading there right now. Earlier today, we had a pretty good test of this zone, and then we rallied. So we came down. You see we went down, got involved right there. We went up about 61-ish, so that wasn't bad. Then we sold off a little bit more, and then you got paid off on the big run up there, about 78, 133.78. So it turned out to be a pretty good trade. We were looking for just that tight scalp, and it panned out. We weren't looking for the end of the road here for the Great Britain Pound USD. It's just very, very, very consolidated. You know, we start talking about chop. I mean, it really is sort of a choppy dynamic right now facing the cable. You can see, well, a lot of traders are going to say, Shane, what are you talking about? You got a 3-day losing streak. That's a trend. That is not a trend. That is not a trend. This right in here is ugly stuff. One of the reasons we put this trade idea out, typically I'd say, man, that area is saturated. I don't know if it's going to work. And then you look at the market dynamic and go, well, it's flat though. But the market's flat. It's not like we were trending hard and bounced off of this 2 times in a heavy trend. The market has been flat really going back throughout March. So I thought we had a pretty good opportunity to get there and get a little whipsaw action off of that trade, and we did. There's your 4-hour chart. You can see we came down, checked the bottom, boom, bounced right up. It's fantastic stuff. Where do we go from here in the Great Britain Pound USD? I have no clue. We're just sort of flatlining right now. Is that trade still good? No, I'd get away from it. It was a good trade, got in, paid us off, 42 pips, something like that. Nice bounce. Now, that one came out last night. It was a good trade, one that I'm very happy with. But a couple of these I'm really not happy with at all. And it's a challenge right now to trade against the dollar. So earlier today, we put out a little bit different trade idea. We took out a look at the Euro Australian dollar, which I think could be a pretty good one just because of the activity in gold is definitely, I mean, there's no two ways about it. Gold is dragging the Australian dollar around by the nose. And that's what's happening. People are watching gold and then they're trading the Aussie. A lot of reasons to do that. One of them is tighter spreads. Right now you've got this Aussie, this Euro Aussie's only got about a 4-pip spread, whereas gold's got about 110 pips. So you can definitely get down with definitely a lower spread for sure, a tighter market on this Euro Aussie, but you can also maybe dial in your granularity to a little bit more acceptable risk appetite. If you're trading gold right now, you're going to have to give these trades room to work, which means you have to cut your leverage way down. If you're trading something like the Euro Aussie, you could probably play a little bit tighter and get the same effect. So in a lot of ways, it's a little more efficient, but if you want that direct market access to gold and the direct volatility, then you just got to trade bullion. But for Forex traders that are interested in gold, you definitely need to be looking at the Australian dollar. So we've got macro resistance in play here for the Euro Aussie. Since I wrote this, we've had a pretty good move, actually. We're up to about 167.25, somewhere right in that zone, and our resistance zone's up there at 169. So as active as the gold market is, I sort of wanted to get this one out, this trade idea out and in circulation, because I think that area right up around 169 has got an opportunity to be a pretty darn good zone for a resistance. You can see you had really a lot of compression going back to April. That April tariff panic of 2025, it's looking bigger and bigger on our charts, isn't it? It really is. I mean, that was absolutely a huge outlier. And now you're just sort of trading sideways. And then you had 3 big losing months. So sort of a compression month and then a breaker. And a lot of that had to do with the gold market. A lot of it had to do with the gold market. And now you're starting to see gold fade and the euro sort of making a comeback on the Australian dollar. So I've got a nice area right there because I don't believe that gold is going to continue its crash. However, in the early going, for right this minute, I could see 4,000 gold again. I could see $3,800 gold again. We can see it. It's happening. We're seeing the daily ranges right in front of our face. And if you do get that, maybe you get a sell-off or a little bit of weakness here for the next several days, maybe the next day or two in that gold market, then you can definitely be set up for a really nice sell there before getting the rebound in gold and then cashing in with the Aussie sort of coming back a little bit. So that trade, I think it was 50-something pips, something like that. Pretty good area, nice macro resistance zone in the Euro Aussie. And the other thing it does is it gets us away from the US dollar, which has been just, it's been difficult. It really has been difficult. I'm going to go ahead and pull up the DXY here, and you'll see on a monthly, I mean, it was very easy for us to diagnose the US dollar before the war. It was easy. He said, okay, Trump's inaugurated right here. We know they're going to cut interest rates to jumpstart growth, and we're still very bearish. L formation, no question about it. No question about it. There's your move. Boom. There's your move. There's your rotation beneath 38%. That is an L formation. Uppercase L in the English language. There it is. Well, the problem is you got a war now. And what's going on now in our bond market and with the US dollar is all of a sudden you're not going to slash interest rates the way that we thought they were. It's not going to be a yard sale. We're not going to pump the market full of money in an attempt to prop everything up, because you can't really do that with oil prices as high as they are, and inflation potentially going to grow from here on in. And that's going to boil down to our second part of the stream, where we're going to break down what we think happens next in Iran, because it's all hooked together. I mean, it is all hooked together. You've got Iran, you've got high energy prices, you've got all of a sudden hawkish monetary policy, you've got a huge drag on your financial system and your market prices. There's no question about it. Factor in that it's an election year here in the United States. 2026 midterm elections are right around the corner. We're going to be sitting here and it's going to be November and they're going to be having elections. And when I look at things like this, what's happening in this Iran situation and the way that everything is hooked together and everything is linked, that's when you know that trading can be really difficult if you're ignoring the fundamentals. If you ignore the fundamentals, God bless you, go for it. Get your system, get your strategy, watch your risk. But something like this, if you're maybe a swing trader, or maybe you're thinking about longer-term investiture, something like this is something we can't miss. And admittedly, I showed up right there. I was in January and I said, we're going low. This dollar's going low. I had us pegged probably right down to this zone. I don't know if any of you remember this. I was looking at 90, all the way from about 89 and a quarter to 90. I was thinking in my head, January 2021 lows, early 2021 lows. That's what I was thinking from the US dollar. I said, yeah, we're going. Well, things have changed a little bit now. Now you have a war, and that's changing everything. It's going to change monetary policy for a long time if it's not rectified very soon. So there's a tremendous amount of pressure to get this thing wrapped up. And a lot of the drag on the United States markets could potentially come from a much stronger dollar. No question about it. So right now you've got the DXY is up big, about 2.25, which is big. For the dollar index, that's big. You can see you had a bounce of about 337 back in July of 2025, and that's coming off of those tariff panics and all that jazz. And then you've got right here, March 2026, you're back up about 2.25. What does it all mean? Still bearish. Believe it or not, 101.07, 101 evens the line in the sand, but we're sort of right around that 13-month EMA, which is 99.59, and we are right around that pretty much every day. It's really choppy in there. It's tough to put a finger on. When it comes to currency trading, typically you get a pretty good idea of what's happening policy-wise, and right now it is up in the air. Take a look at this chart. Boom, big rally on the 13th of March. This is all wartime stuff. going right back into here. This is all wartime stuff. Look at this action in the dollar. Just crazy. That's crazy. Compression, inverted hammer. There's a rally, inside bar, boom, big rally, sell off, rally, sell off. Trade both sides of the rally. I mean, it's craziness. So when we look at a chart like this, I think in the trader's handbook, something about a 50-foot pole. You don't go near it. And I'm watching this closely, and I'm going, man, do you bet against the dollar or don't you bet against the dollar? And that's why we started making the transition over to maybe some things that aren't necessarily denominated in dollars. And I think that Euro-Aussie trade's a pretty good one to target, at least for the next 72 hours or so. We'll see how it plays out. All right, another trade idea that we have to look at. I don't have the slide for it, but that's all right. This was one I talked about yesterday. I got the question about the dollar CAD. So Shane, look at the dollar CAD. We had a 50% level on the monthly chart coincided with our 13-month EMA. So we were right there at about 139, 138.19 and 138.11, basically looking at about 138s, right around 138.05, somewhere in there as being a pretty good entry point to the short. Didn't really work. I mean, there's no two ways about it. Now you're printing about 138.52. Theoretically, you probably could still be in this trade if you wanted to be, if you liked watching the tote board go against you. For me, I just don't have the patience for it. Really frustrating, though, because this is something that, you know, It's one thing that I'm thinking about really adding into my repertoire of rules, and I've got a few that I go by, pretty religiously. But stuff like this, we go to 138. We go 138 yesterday. We print 138. We were looking, I think, at 138.04s. It was an old trade idea. I'll look it up tomorrow and we'll recap it. But I'm looking at 138.04s. The market goes to 138, and then it just sells off down there to about 137.72. That's the money we were looking for, realistically. I mean, that was 28 pips, and it was fast, and it was easy. And then the market reverses. You take out 138. You get a little doji action there, and then the rubber hits the road. You're either going to break down from our key levels there, or you're going to keep going, and the market's kept going. So, if you're still holding shorts here, it's not a tremendous move against you. I understand 138.50, and you probably went short at 138.04. So you're probably not out of the game depending on your leverage. But, it's a duck. It's a duck. It's a near miss. It's one of these that was a near miss. And then you get down in here and you just don't quite get in on that trade right there. And that's the misery of trading sometimes. The hard part about trading these horizontal support and resistance levels, and it's been something that's plagued me through my career, is I will sit and wait because I know that's what you have to do. You have to sit and you have to wait. That's the game. The fool rushes in. People that overtrade aren't around very long. They all get beat, and they all usually get chewed up and spit out relatively quickly. The hard part about waiting is if I'm sitting there at 138.04s for my entry and the price goes to 138 and then reverses and I know I'm watching it going, well, that was the money I wanted. And then you're saying, okay, well, is it still there? The next time the DOM goes up my way or the next time the charts go up to my entry point, will this thing still work? And that's a real hard question because I've been on the wrong side of breakouts many a time just by saying, you know what, you probably should have just pulled it. We didn't get filled, pull it, go on to another market. It's hard to do. It's hard to have that kind of discipline. It really is hard to have that kind of discipline because what inevitably happens is you have to trade to make money, and missing trades over time can be just as painful, and I mean just as painful as taking losing trades. The problem is when you miss that initial entry and then you go with your entry and then you lose that trade, you just doubled up. You took a winner and you took a double loss, essentially. You didn't get the money. You didn't get the money from your trade, your winning trade, and then you lost when the thing broke against you. That's tough. I mean, that's really tough psychologically. It's hard to say, guys. It's hard to say. I'm going to look at the US 30 here for a second, and then I got a bunch of questions right over here that I need to get to. So let's go ahead and get to those right now. Let me see. A lot of new names in the room. Let me see. 1906. Can you take a look at the CAD Swissy? Absolutely. Ask and ye shall receive. CAD Swissy. We'll be sure to do that here in just 1 second. Let's see. All right, T. Marina, good to see you, T. Shane, since Canada is one of the top producers of gold and oil, How do Canadian pairs react when oil is down, but oil is up and gold is down, and vice versa? Is there a combined effect that impacts the U.S. dollar, Canadian dollar? I lean on oil and fossil fuels, T. I don't think of the Canadian dollar as showing much of a correlation to gold. I think that a lot of times people will say that, okay, it is a gold. It's also driven by gold, but what happens to gold prices, when the dollar fades? So if you got the dollar linked to the Canadian dollar, and let's say gold prices go way up, typically that means that the U.S. dollar is coming down. So it's really a tough trajectory. You could actually make the same thing for oil, make the same argument for oil. I always fall back on fossil fuels, especially natural gas is a big one, but also oil. 90-something% of those exports go to the United States, and that's worth anywhere between 7 and 9% of the Canadian economy, Canadian GDP. So I sort of lean on the energies end of it, but you make a good point. I mean, you really make a good point. I would have to research it further. I've never thought of gold as being a real driver of the Canadian dollar. It certainly could have an impact on the U.S. dollar, Canadian dollar. That's for sure, but that's a great question, T. I genuinely don't know. We'd have to go to ChatGPT and see if they've got anything to say, but I don't really trust ChatGPT too much when it comes to trading. Good question, though. That's for sure. Let me see, T. Marina. Yeah, it's so hard waiting a lot of the times, and learn to wait the hard way. That's the problem with waiting. It's hard. It's difficult. I mean, even you've been in this game a long time. A quick anecdote, and then we'll get into the price action again. But I was talking to a trader not too long ago, and the gentleman was had a few years on me, so he'd been in the game a long time, and basically he felt bad because he blew his account out. And he said something like, said he was embarrassed, or I don't think he used the word ashamed, but he was embarrassed because he knew he was in the game long enough to know you can't do that. You can't add to losses. You can't do it. And he did it. And the overriding reason was he felt a sense of urgency. He says, I've been doing this a long time and I'm tired of waiting. And waiting meaning not just for waiting for our trades to come through, but waiting to meet those goals that we all have. He's tired of waiting, and I can relate to that. I mean, there's some days where you look at the money you made. Like I showed last February is a great example. I showed my performance on one account, and I took a look at it, and the stats are there, the numbers are there. I wouldn't say it was impressive by any stretch of the imagination, but it was viable. You could actually do that month in and month out, and it's a living. And you look at it and you go, man, what if we just add a few zeros on the end of it? What if you go from maybe netting, to whatever the net was, $1,400 or something? God, why not tack a couple zeros on it? Why not just up the leverage and walk away with $14,000? And that has to do with your waiting your whole life to try to get into a big level. And that's exactly what he was talking about. And what happened was he waited and waited and waited, thought he had a pretty good setup, was trading some crypto, some really volatile stuff, had a pretty good opportunity to make that big stack of cash, and then just jumped in and went after it, went for it. And there's nothing wrong with that. But the waiting, I hear you. Believe me, I hear you. It's not just about waiting for your trade setup to come your way, but also about reaching your financial goals. And every trader that's watching this, and there's a lot of you guys out there that ask me these questions all the time. I mean, you're going to have to decide for yourself how long you're going to sit in front of these screens and how much you're going to put into it, and how long you're going to wait to try to make the goals make your ambition a reality. And there's no right answer. It's different for everybody. I recommend starting out at least as this being a supplement. If you're supplementing your income with trading, that's great. Then you just transition into a full-time trader over time, and there's your goal. Your goals are met, build your account, level up to whatever you can level up to. That's great. That's how it's done. The problem with a lot of folks is they jump in and they try to be a professional trader from day one. And they sit here and they sit in front of these screens for years. I remember talking to one guy, one last story, and then we'll get back into the analysis, but I talked to one guy back in the old days when I was just starting out. It would have been my third year of trading by myself. So yeah, my third year in the market, it would have been 18 months after the 7 V-Bar trading group disbanded, and I was on my own. And I was trading my own money, and it was a small account, and I was in there slugging it out every day. And I remember the house that we were in at the time was being sold, so the realtors would bring people through. And I remember they brought this couple through, and this gentleman was watching me, and I had the big screens, and I was sitting in my office just like I always did, sucking down my coffee, just finished my morning workout, and I was in there trading. I was trading crude oil. That's what I was doing with my life, still do. And I remember he walked by me, and he just sort of laughed, and he said, I tried to do that full time. And he goes, I sat there for a whole year and I made $3,200. And I decided I had to go do it again. So in my mind, I sat there and I said, wait a minute, you tried your first year of trading, you went for 12 months and you made $3,200. And in my head, I'm thinking, okay, just up your leverage and you could have walked away with anything you wanted. And in his mind, he said it was a complete waste of time and quit. There was no money in it. So it's all in the eye of the beholder. It's what you want to do with your life. And I highly recommend being patient. Wait. And when it comes time to wait some more, because you'll find that the big windfall and the big score and the big trade and the big, your goals, they're always going to be right around the corner in this game. That's the way trading works. If you make $1 million, you're going to be thinking about how to make the next $1 million. That's the way that this works. So be sound, risk management, leverage in check. Don't blow your accounts out. Remember, as long as you have money to trade, you have money coming in, you're viable, you're liquid, and you're solvent. And that's what it's all about. That's for sure. Geez, I like the stories. Keep them coming. Yeah, that's for sure. Too many stories, though. That's for sure. No, you can't trust ChatGPT, T Marina. You sure can't. All right, everybody, let's get out to price action here, the CAD Swissy. This is actually, it's pretty dirty. I mean, that's what I would call a really dirty chart. Sort of looks like a barcode. I don't think I have a barcode here anywhere to show you. Yeah, right here. So this is sort of the formation. I don't know what this is, but that barcode, all those squiggly lines right there, those lines, that's what that chart looks like. It's terrible. That means what? It's up, it's down, it's up, it's down. It's trading inside of a range. It's a barcode. It's really difficult to trade. Well, what you can do is it's pretty easy to see exactly where the demand zone is for at least the last several days. You've caught some pretty good bids there. Let's step back to a weekly, something like this. Okay. You see, we analyzed this one a while ago. Let's go right here. A couple of things. Number one, the Bollinger Bands are flat, and they're sort of getting closer together. You're no longer trending. Even though you're trickling maybe to the bear a little bit from those highs back in December, you're still moving sideways. So if that's the case, you've actually got a pretty good trade on the horizon. Now, you wouldn't play this because it's a trend. You're not trending, but you are in rotation. We've got a moving average there at about 51.18. That's your 13-period EMA. And you've got this spike low up to a spike high. Interesting market, isn't it? Very interesting. It's flat. So we can spot right off the top of our heads where the demand zones are. Right there, all the bidders stepped in towards your lower Bollinger Band. 56, 57, somewhere down in there. Weekly Fibonacci retracement sequence, 78%, which sort of speaks to that really rotational, that deep market. That's not a bad area. That's not a bad area down there. 56, 57, maybe 56, 70. You could do that. If you wanted to be a little more aggressive, I would be looking at 62%. I'm not really interested in 38%. If it trends up from here, that's fine. Let it. We'll probably have an opportunity maybe to sell a swing high up here, maybe a liquidity sweep area. But for me right now, I want to see a nice big deep. I want to see a nice big deep retracement down into the guts of the last 2-3 weeks range. And those lines in the sand would be 56.86 or 56.57. And I would much rather take that one right at this lower Bollinger Band, give us a real high probability opportunity to get a bounce for maybe 25 or 30 pips back up into this range. But for right now, you're not trending. The overall market sentiment, is bearish probably for the last year or so. But I wouldn't I wouldn't be in too big of a hurry to either sell, and I wouldn't be in too big of a hurry to buy. Even though this area right here looks like it's set up pretty good. You're up about 9 pips. That low went down to about 57.15, but I wouldn't just buy it at market. I think it's too dicey. You want to see a move here. You want to see a move here in this CAD Swissy. So interesting market. I like what's happened over the past several days. You can see with our lines on the chart now. Take a look at the daily. Where has this market failed at? I mean, there's your demand zone right at 38%. Do you still want it? I would let this go. I would wait for a big move maybe down into here. One of those two levels gives you a great shot. Bobby Bob, good to see you, Bobby. Welcome. That's for sure. But that's a pretty good look at a market that's not too shabby. Not a bad one. Let's look at that US 30 for a second here. We got a couple more questions to answer. Really just sort of ugly. I remember we've lost some trades this year, of course. The trade ideas, we're still pretty confident about them when we put them out, or when I put them out. But the one of the ones that really still pisses me off is this 50,000. Because it was a good trade. It was selling. We were selling right under there, and then we saw the 3-day compression, and that was really the top of this Dow Jones Industrial Average. So we're starting to fade away from some of our key levels. 50,000 was a big one. 25,000 in the NASDAQ was a big one. 7,000 in the US 500 was a big one. We're starting to get away from those a little bit. So when we're looking at this type of a chart, you say, okay, Shane, what do you want to do on the daily? Are you still bullish or are you still bearish? I'm neither. With this war raging on, and with what the developments that we think are coming our way potentially this weekend, I have no desire to do any of it. I really don't. I get the questions a lot. You get them everywhere. Are you bullish or bearish? I get them in meetings. You'll have meetings with other traders. What do you like? Are you bullish? You bearish? I don't know. I don't know. But I do know exactly how to measure the price, and I know how to measure what's going on. 50,000 is still going to be a huge level for us, but it's not as important as it was. Now, let's put our thinking caps on. When is the world likely to pile back into stocks? It's a pretty easy answer. It's when your war's over. It's when your war's over. That's when you'll pile back into stocks, because then we'll start getting back to basics on unwinding monetary policy, addressing an energy shortage. I can tell you that in the area that I'm in here in Montana, the railways have been running nonstop. And guess what they've been taking? They've been taking oil tankers. So domestic production here in the United States is up, and it's up big. And I got a feeling that they ramped it up because they're anticipating maybe some significant disruptions out of the Middle East. I don't know that for sure, but I can tell you that knowing people in the oil field and what they're doing, they will go to 24-hour production over in the Bakken oil fields, and they'll do it fast. In the shale oil in this country, they will go 24 hours if they haven't already. Now, that was something we did back in 2013 to meet the demand on really high prices. But if it looks like crude oil is going to be at 100 or 125 for a while, don't kid yourself. They will go 24-hour production at the drop of a hat on a large scale. They already do that in some areas, but they will do it on a large scale. Now, what that means is hiring a bunch more people and getting the oil fields up and running at full capacity, which it looks to me, judging by the action on the railways up in this region, which are directly, I'm not too far from the oil fields at all. They take a lot of that shale oil out to the West Coast for shipping, and it's starting to ramp up. There's no question. So what does all that mean? It means that if you can get a hold on the energy situation, and then maybe get some of those rate cuts that we were promised back in January, right? If you get some of that, that's probably when you retrace and you hit back up to 50,000. Until then, you're not hitting 50,000. So what we have is a catastrophe month for stocks, no question, 5.75%, the biggest losing month. Actually, it's on pace to be a lot bigger of a loss than last April's tariff panic. But you can see right there, nice, what is that? Inverted hammer. Hammer. Boom, there's your reversal and your washout. So what can we do right here just to identify some levels? First thing, 13-month EMA is alive and well at 45,874. That's big. We're trading right around 46. Okay, so you're still above that moving average. Fibonacci, it's very obvious here in this sequence. I want to go right from that low. Theoretically, you could work from that spike low there if you wanted to in August of 2025. I'm not interested. This spike low is the one that matters. It's off the April panic. Think in terms of super cycles here. Go with me on this. That was the last big bearish market driver, was April, the tariff panic, Independence Day. Well, this April, you're going to be looking at a war more than likely, maybe Invasion Day. And so what do you got there? Big sell-off and then a bounce. This month here, if we don't get a late month bounce, maybe a recta or a peace deal or something decided in the Middle East, you could close on a low. Very possible. We went right to 38% there. So 45,000, 45.125 line in the sand. If we break beneath that, then we're going much lower, much lower. And do I think it's possible? Yeah, I do. It just depends on what happens with your inflation, with Iran, and with all of it. That's a huge chart. I mean, when you look at what's happening there, that's a big bearish move. How does the next candle form? Do we get compression? Do we get a peace deal and then a bounce up right back to 50,000? All of these scenarios are possible. That's what makes trading right now so difficult. It makes it really difficult, that's for sure. All right, let me see. I got a few questions, and then we're going to go over some of what to expect here over the coming days in the Iranian theater, and then we'll go ahead and sign off and come back tomorrow and try it all again. You're absolutely welcome, Naomi. Let me see. T. Marina, have you ever successfully traded a strategy in a demo account and then took it live and failed? Oh, yeah. Oh, yeah. And why did it happen? It's a great question. When I first started my job, initially I had to read a great big volume on market profile and get good with that. And then I had to read a couple other psychology books. And basically, my mentor was just figuring out if I would stick with it. He didn't really care if what I read was important. He knew that when you trade, you can't learn how to trade from a book. He knew that. You had to get in the market and get in the pocket and make some trades and make some ideas come to fruition and make some money. However, the next part of my training is after the reading was I had to go to demo. And I traded demo for 6 weeks. And I made money easily in demo. And we had a couple of strategies that were no problem. Basically, they were scalping strategies. We had some algorithms where we could take short-term positions and things. But it was all geared around 3, 4, 5, taking 6 ticks, things like that in the crude oil market and in the Euro market, Euro FX. Long story short, yes, when I went to the screen, the first thing I did was start losing, and I couldn't figure out why I was losing. I go, man, I've been doing this. I've been executing these trades. Why am I losing? I wasn't hesitating. I wasn't overtrading. What was happening? Slippage and commissions entered the equation, and I found that being profitable was a little bit more difficult in the live market. I wasn't being filled. My fills were horrible. And a lot of that had to do with me trading out in the boonies in Montana. I was out in the woods basically in my house, and I was trying to trade with like my download, and my download speed was like 1.5, and my upload speed was less than that. So I legitimately was the last guy to the market. Well, on the demo they didn't show you that. They basically gave me perfect fills. So what I was getting fooled into on my demo was my tick scalping was perfect. I could do it. It was perfect. And it just wasn't perfect. Because a lot of trades I would just bail out with like a 2-tick gain or a 3-tick gain or a 1-tick gain. And then my stop loss would get hit. I would be out perfectly at my stop loss. There wouldn't be any slippage on my stop. And I found that once I transitioned into the live market, I couldn't get away with making those decisions, stop market orders for a stop loss. And I couldn't get away with just getting out with a tick. It wasn't working for me. There was enough slippage in there to where my profitability was basically nil. It was wiped out. So I had to go back to the drawing board and get a little more patient with my trading and also look a little bit bigger instead of just sitting there trying to take one tick 100 times a day. It just didn't work out. So to answer your question, yeah, that's exactly why it failed. And I don't talk about slippage a whole lot, but it's very important, especially if you're trading futures. There's not as much of it now. These markets are so big and they're so deep. There's not as much slippage now. I'm not kidding you. No way. You get a decent broker, there's not much slippage in futures. And I'm blown away by it, absolutely blown away. Let me see, Yanni, good to see you. Yanni Malik World, good to see you. Welcome. Let me see you. Naomi, okay, gotcha. Tina Jing, yeah, I have a deeper understanding of being patient. It changes you, Tina. You've been in front of these screens for 5 or 10 years. It changes you. You get a deeper understanding of a lot of things in life. That's for sure. But patience is one of them. Let me see. Bob G's US 100 is finally moving away from the 24K mark. Interesting. Yep, it's tough being patient, Marvel. It's not much fun. That's for sure. Let me see. Marvel, the chart is the best teacher. It humbles the proud every single time it does. Every single time. Let me see. T. Marino. Whoa, yes. Slippage and spreads. You got that right. Slippage made a man out of me. I thought I was, honestly, guys, I thought I was a hot shot. I was on the demo for 6 weeks, and every day I was just killing it. Every single day I'd sit there and I would trade and I would just kill it. And I got into the real swimming pool. I got into the deep end, and then all of a sudden, slippage was knocking out those trades that were little winners. Basically were scratch trades. Those little winning trades all of a sudden were little losing trades, and I found that I was taking way too many of those to make it happen. That's for sure. Yep, there you go. OMG, my same struggles with spreads and picking my pairs and sessions more strategically. To pick your spots. when things are going good for me, I'm pulling the trigger like maybe 5 or 6 times a week. And that's what it's all about. Win. All make money every day. Win. All right, guys, let's take a look at our expectations on poly market. Like I said, this isn't gospel. We don't necessarily believe 100% of what poly market says, but these things have been incredibly accurate. Let's see, Ralph H., but you didn't give up. No, couldn't give up. You'll find that too. You'll find that a lot of folks have that mechanism to where they can't give up. It's just part of their life. And that's the thing about being a trader is you're always there. We made a commercial a long time ago, back when Nick and Connor were here. We shot it over in London, and that was one of the things that I said when I was asked my question about what a trader is. And I said, you're always there. You'll know you're a trader when you're always there. And that's what it boils down to. Gets in your blood. That's for sure. Gets in your blood. All right, here we go. Poly market odds for the Iran situation going into the weekend. These are going to become more and more important, believe it or not. There's a lot of folks watching these. There's a lot of people believe that these are insider trading as well, with people in the administration actually capitalizing on things they already know are going to happen. I'm not going to speak to that. I'm not going to say that, but I can tell you that a lot of this stuff these days is very, very fishy. It's very fishy. I don't like it. I don't understand how you can have prediction markets where you can actually bet on the outcome of a war. I genuinely don't understand it, but it's here. It's a predictive tool, and we're going to use it. We might as well use it. All right, so what do we got here? I'm not even going to worry about crude oil. I think we've got that nailed on our own. Iran-U.S. ceasefire, I'm not really worried about that. That's the one. That's the one for this weekend that I think really shakes the foundations of the entire world. This is the one that everybody's talking about. We've got the evidence there. We've got the 5,000 Marine amphibious that went last week. They should be in country. They should be pretty much in country by now, in region. They should be in region by now. You've got the 82nd Airborne that supposedly were deployed yesterday. They should be getting there momentarily. So you're going to have the 82nd Airborne and the Marine amphibious units there. That's on top of another 50,000 troops that are in the region that could be called up at a moment's notice. So does the U.S. enter Iran by? A lot of folks believe this is a foregone conclusion, and the reason why is the oil situation that I talked about earlier. We had a state of emergency declared, I believe, was it in the Philippines? I don't recall there's so much news, but there was a state of emergency declared from an island nation, string island nations. They don't have any more fuel. So you're starting to run out of fuel. So if you start to see that, maybe out of the Philippines, maybe it was Indonesia or the Philippines, I'm just not sure, but go ahead and Google it. There was a state of emergency declared because the fuel's stopping. The oil's stopping. So you have that. You look for that out of Japan. Not necessarily a state of emergency, but the situation in Australia where all of a sudden the fuel's running low. It's going to happen in Japan here relatively soon as well, and across that Asia-Pacific region. That's a big deal, and that could really force the hand of the United States to try to wrap this thing up. And one of the ways that they could try to do that is escalate. That would be boots on the ground. So where are the targets going to be? So we're saying, listen, we'll get into that in a second. March 31st, 20% chance. So in the next week or so, a 20% chance. I think that's where the outlier could be potentially this weekend. Boots on the ground, U.S. forces enter Iran. April 30th, 62% chance. December 3rd, 72% chance. People believe that in some form or another, this is going to be inevitable. I think it could be coming this weekend. I really do. I don't know for sure. I don't have any inside information. We're just trying to put 2 and 2 together and get 4 if we're lucky, right? Will the Iranian regime fall by the 31st? We know that that's not going to happen now. Karg Island, no longer under Iranian control. Many believe this to be the target of the U.S. invasion, is Karg Island. I don't know that. I mean, I hear a lot of things. But as far as this goes, March 31st, they believe it's 11%. April 30th, 36%. May 31st and June 30th. So for the next several months, this potentially could be a target. And remember, that's the oil depot for Iran. That's where they do all of their. Well, look at that. Our odds just went down. There you have it. Okay, here we go. Military strikes. Iran military action. Which countries will conduct military action? Not worried about that. Not worried about that. That's the one right there. U.S. invade Iran. In my view, that's the big one. As far as, all this other stuff, I have no idea. But the one we're watching is boots on the ground. That'll mark a major escalation. The other thing to watch is the energy war. We talked about that earlier this week in depth. If we start blowing up big big energy installations. Essentially, Trump's ultimatum over the weekend, 48 hours, and he's going to flatten the energy infrastructure. That's a major escalation too, because Iran has pledged. They said, listen, if you knock our energy out, we're going to start knocking desalination plants out, which means there's no more fresh water in the Persian Gulf region. And there's a lot of folks that live there, and that's going to be a real issue. It's a powder keg. It's a tinderbox. The markets aren't believing what Trump's saying anymore. That 10 million barrel, or excuse me, the 10 ships that were let through as an act of goodwill from Iran, that was designed to lower your oil prices, and it hasn't done it. The intraday stuff, it just hasn't worked. The markets get wise after a while. People get wise. Traders get wise. There's probably no smarter group of people in the world than traders. They know. They get in there, their gut, they know. And right now, that statement from earlier today, that Iran's ready to make a deal, that they want to make a deal, that they let 10 through as a present to us, as an act of goodwill, they're not buying it. The oil traders aren't buying it. And that tells me all I need to know. I feel like they're going in. Just a gut guess, gut feeling. I think they're going to go in. Does it work? Well, we'll see. I have no idea. That's for sure. All right, everybody. I'm going to go ahead and sign off here. Let me see. Babji, slippage is what keeps me on the indices and gold. I can't trade beyond the yen pairs. All right. Gotcha. Definitely overlooked. Real market conditions are a completely different game. I was a baseball player in college. I had an opportunity to play at a fairly high level here in the United States, and it was a lot of fun. Made a lot of friends. I talked to a few of them actually last week after 25 years, right? But there was a big difference between taking batting practice and then playing in the game and hitting in the game. And we had guys that we would call BP All-Stars. They would be batting practice All-Stars. They would be all-world taking hitting practice. But when they would get in the game, they couldn't hit wind. It was like they were swinging a sword. And I see that a lot in the markets. Players get in there and they knock it out on demo, and they get in the live market and they can't do anything. Now, here's the beauty of this, and this is how it's different from when I was a kid and I was young, or I was just getting involved, or early in my trading career. If you're a great demo trader, you can beat these prop firms. You can beat them. Their fills are not the same as the live market. You can get in there and you can get them. So if you're a great demo trader, I highly recommend trading prop, because those are demo accounts and you can get in there and just kill them on the demo. Now, you're going to have to probably fight for your money from a lot of these firms, but they're out there. And if you're a great demo trader, that's a skill in itself now. You have that opportunity. That didn't exist in the old days. I mean, the fills that you'd get on demo, that is not what you're getting. That's not what you're getting in the live market. It's a lot better now. The markets are a lot more efficient now in that way. The other ways, we'll talk about that later. But in that way, yeah. So if you're a great demo trader, don't hang your head and say, I'm never going to make it. Yeah, you can. Get in there and just whip up on some prop firms. That's what I say. I don't care how you win, just win, right? Let me see. Overlooked real market conditions. Tina Jing. Yeah, I noticed that too. Commission spread and slippage not achieving the same when I'm marketing my trades on TradingView. TP3R is not real. Yeah, absolutely. A take profit, a 3 risk reward is not a 3 risk reward in real trading. Remember, more than likely, your trades are going to have to go a tick above. On a buy, your take profits at $100. It's going to have to go to probably 101 for you to get filled. Especially when you're trading a big contract like maybe the E-mini S&P 500, you're going to see that to get that profit target hit, you typically need to go a tick beyond, which you can account for. You really can. You just build your strategy a little bit different. That's all. Maybe limit your expectations. Be a little more conservative. All right. Absolutely, Marvel, you are welcome. All right, I'm going to go ahead and get going. We've been rambling on long enough, but there's a lot going on here. Big session, key session coming up tomorrow. Not really anything on the news schedule, but we are going to be talking a lot about Iran. We're going to be getting you ready for the weekend. If you're, I'd say that it's probably a relatively important stream for me, because I like to get my ducks in a row and make sure that everybody understands the risks that they're facing over the weekend. But all in all, it's been a decent trading day. Stocks are really starting to bleed red, though. Dow's off almost 500, 450, and then you've got the situation with the VIX creeping ever closer towards that 30 level. The dollar index is almost at 100. Now we're at 99, 93. That's big. You've also got WTI crude's up 5.5%. buckle up, guys. Buckle up. It feels like the next wave of volatility is coming. That's for sure. All right, everybody. Thank you for joining me today. Remember, have a fantastic session. And as always, trade the action well, and we'll talk soon. See you.